is capital gains tax? Hi, it's Cristina Valdés, Corazón Team at Realty Austin. Today, I want to talk to you on how you can minimize, avoid, or defer capital gains taxes. You can minimize the overall tax liability on the sale of an investment by making sure that you have owned that investment for more than 12 months. Capital gains tax rate ranges from 15 to 20%. Now, if you have owned that investment for less than 12 months, that falls into ordinary income taxes, and that rate is at 37%. So that is the difference between paying 20 cents on the dollar for taxes versus 37 cents on the dollar for taxes. That's a significant difference, especially when you get into the big gains. If you own an investment property and are thinking about selling it, you could actually move into it for 2 years and avoid paying some capital gains taxes. The way this works is current IRS rules indicate that you have to have lived in the property 2 out of the past 5 years in order to qualify for the exemptions that we're about to talk about. If you have lived in the property for 2 of the past 5 years, it's your homestead basically, you are eligible for, as a single person, a $250,000 exemption, and as a married couple, a $500,000 exemption from the gains. So basically, you as a married couple could avoid paying capital gains taxes on up to $500,000 worth of gain. That's a significant savings. Capital gains taxes can also be deferred, meaning you're pushing them down the road a little bit so that you don't have to pay them now. The way that you do that with an investment property is you use something called a 1031 tax exchange. Some things to know about a 1031 tax exchange is that you need to have an intermediary involved who actually makes sure that the transaction is compliant and holds your money in escrow until you complete the transaction. You have 45 days to identify the property that you're going to replace the one that you're selling with, and you have 180 days to close on that transaction. Some important things that I think you need to do before you consider a 1031 tax exchange are you need to talk to your CPA to find out if it's worth doing. When I have done a 1031 tax exchange, I've called up my CPA and asked him to tell me, give me an estimate of what the taxes are that are involved in the transaction. If those are like shocking to me, or I just think, okay, well I want to avoid paying those and move instead of paying $75,000 worth of taxes, I want to take that money and use it to purchase another property. So you do the cost benefit analysis on that. It doesn't work for everybody. Sometimes you just want to take that money and do something different with it. But if your intention is to sell an investment property and buy another investment property, a 1031 tax exchange is a really great way to save on the income taxes and just defer them into that future property that you buy. So you want to have those conversations with your real estate agent, your CPA. Everybody needs to know what's happening before you actually put your home on the market, because there's certain things that need to be in place when you close, and that it is best to be done ahead of time and not at the very last minute. Once you've had those conversations with your CPA and you've notified your real estate agent that that's what you're going to do as a 1031 tax exchange, you then need to research on who you're going to hire as a 1031 tax exchange intermediary. This is a company that helps you through that transaction and keeps you compliant and make sure you follow all the rules so that it doesn't end up being a taxable event. and they hold your proceeds until you purchase your replacement property. There's a lot of paperwork involved, and so their paperwork is involved on the the sale side of your transaction and the actual purchase of the replacement property. So you need to make sure that you're hiring a company with a good reputation in your area. I recommend looking for the replacement property way before you put your investment property on the market for sale. In this environment that we are in all over the United States, the real estate market is moving very quickly. Your property is going to sell. You are then going to find out that 45 days is a very short timeline to identify properties as replacements. I've done a few 1031 tax exchanges, and sometimes you just feel so pressured to buy something that you might make a bad decision. So if you give yourself enough time, meaning start a month before you put your investment property on the market, then you've got those 30 days. You've got the 30 days it takes your investment property to close, and then you've got another 45 days of putting some sort of a deal together. It is well worth taking the extra effort and starting ahead of time than like feeling like you're under the gun and, oh my gosh, I just have to buy anything. So do that and you will thank me later. I'm Cristina Valdés, Corazón Team at Realty Austin, and now you know what capital gains taxes are and how to minimize, avoid, or defer them. I am so happy to share this information with you. Please remember that we love your referrals at the Corazón Team. If you know of someone who's thinking about selling, buying, or investing in real estate, please don't keep us a secret.